Always consult your tax advisor before making any decisions. This video is for information only. Find the full video at modernideasforbusiness.com.
Let me talk a little bit about each of these. So QSBS, the 15 million base exclusion, it applies on a per legal entity basis. So basically each person can get $15 million. You get $15 million as an owner, business partner could get $15 million, your investor can get $15 million, and so forth. From the IRS lens, certain types of trusts, irrevocable trusts, also qualify as a separate entity. So that means that trust can get a separate $15 million quota in terms of capital gains deduction. And lastly, if you have family members and they own stock, they can also get $15 million in capital gains deduction. And so this is what stacking looks like. The business owner gets $15 million in exemption. The trust gets another $15 million in exemption. Family members get $15 million in exemption. And I was recently talking to a tax lawyer that mentioned that because a certain business owner had so many children, they were able to set up multiple trusts. So they were getting, in that second layer, they were getting multiple $15 million exemptions. And I was recently talking, so they were getting, in that second layer, they were getting multiple $15 million exemptions. So the capital gains exemption can start stacking up, in this case, up to $45 million or more. So again, this is where advanced planning can make a big difference in the tax outcome, even for QSBS qualifying companies, because each of these entities would have to hold the stock for at least 5 years. So now let me talk about the benefit of a high basis QSBS. The actual rule of QSBS is that you get the greater of 15 million or 10x the initial investment. Taxes are usually something about the lesser of. This is one of those few provisions where they're going to lean into the benefit of the taxpayer and give you the greater of. So what does that mean? If you found a tech startup as a C-corp, because you started it from nothing, your basis is zero. So you default to option one. You'll get $15 million in QSBS benefits. Maybe you can stack that up later on as you get close to an exit. But for many of us that have started our business as an LLC or an S-corp, to take advantage of QSBS, we would convert to a C-corp. When you convert to a C-corp, it's treated as if it's a new investment. And most of our businesses, because they are currently operating, generating revenue, generating profits, the value wouldn't be zero. And so in this case, when we convert from our LLC or S-corp to a C-corp, if we say, I think today's value of the company is $3 million, you would take option two, where it says you get 10x that initial value. So in this case, $30 million in capital gains exclusion when you sell the business. So you get to choose between the base 15 million or 10x your basis. And if your conversion basis is 3 million, that's 30 million. If your conversion is 10 million, you can get up to 100 million in capital gains free. So it's a really powerful lever. And it's kind of like an unexpected blessing for all of us that's ended up starting our businesses as LLCs or S-corps. So what does this mean? Let's say your business today is doing 10 million revenue. It's a 15% margin business. You have a 1.5 million EBITDA. Average 1.5 million EBITDA business, whether it's in manufacturing or services, trades at say 8 times. So it's $12 million value today. Now you could convert this business to a qualifying C-corp. And if your goal is to grow the business, let's say 2x it over 5 years, so it's gonna be a 20 million revenue business, your margins expand a little bit. So now you're a 3.5 million EBITDA by end of 2031. And let's say conservatively, this business trades at a 10 times multiple. And now the enterprise value is 35 million. So in one universe, you didn't do anything. You just kept running the business as is. In 2031, you're selling your business. It's $35 million. All of it gets taxed. You're going to pay probably around $8 million in federal tax from capital gains. Depending on which state you live in, let's say on average, you'll pay about $2 million in state taxes. So your net after-tax proceeds is only $25 million. If you had converted to QSBS in 2025 and you set a conversion basis of say a modest 3 million, you would pay taxes on the first 3 million, but then you get $30 million, 10x that basis, capital gains free. And you had a little bit left over, so you might pay an additional 2 million. And so you end up paying taxes on only 5 million of the 35 million. Huge difference in outcome. And again, it's one of those few levers that you can pull that will have a multi-million-dollar impact on the end results. You just have to plan in advance. It's kind of like getting 2 turns more in a multiple when you sell. So you hear all of this, it sounds interesting. I found then the next step is for business owners to go to their CPA and say, hey, I went to this webinar. This guy was talking about QSBS. I want to look into it. The most common response from the CPA is, shucks, you're not eligible because you're an LLC, you're an S-corp. This thing, it only applies to C-corp. And so I want to preemptively let you know that there is most certainly a way to restructure an LLC or an S-corp to a QSBS qualifying C-corp. And it's very easy for LLCs, or LLC partnerships. For S-corps, you would have to do an F reorg, which is still very manageable. So the next question would be, okay, fine, you can do that. And then they say, but if you're a C-corp, you get double taxation. It's very bad. You're gonna probably lose more money than you would save when you exit. And once again, I want to preemptively let you know that there is a simple structure that allows the business owner to reduce that double taxation leakage so that you're not actually losing a lot of value in the interim 3 to 5 years until you exit. So this can also be solved. Now, of course, some business owners will say, I can't wait 3 to 5 years. I plan to retire in the next 1 or 2 years. And that's totally fair. And of course, some people are just going to retire and then they're not going to work, not going to start another business. And that's totally fine. But for some of us who are serial entrepreneurs and say, I'm going to sell this business because the market's hot now, and then I'm going to start something else. Maybe it's an AI startup. Maybe it's something else. If that other business is also QSBS qualifying, you can roll that basis and keep the clock going in the second business. So this is also partially solvable. And lastly, when I go to conferences, when I hear people talk, other M&A advisors talk, a lot of times the pushback is private equity does not do stock deals. They only do asset deals. And I'm going to say from experience, that is simply not true. There are plenty of situations where private equity does stock deals and stock deals for QSBS qualifying C-corps. So again, most of the perceived problems on the surface are solvable. But I want to be honest and mention, QSBS is a very niche topic. It's not something that every tax expert practices. And in general, the tax preparer who gets paid $1,000, $2,000 a year to file taxes is not a QSBS expert. And I think it's because of the deep expertise and niche nature of this topic, it's important to work with someone that has done a lot of these transactions. So I'm going to talk a little bit about each of these so that you also have a sense for how you can mitigate some of these hurdles, because even though it looks complex, I think it's a huge benefit that's accessible to a lot of business owners. So first of all, if you're an S-corp, what do you do? Most S-corp owners look like this. They have a structure and then the owner owns the S-corp. So what do you do in this situation? You do what's called an F reorg, and the resulting structure is what looks like on the right-hand side. And there's a lot of benefits to this, despite the apparent complexity. First of all, you'll notice that there is a new S-corp on top of the C-corp. And that C-corp is your new operating entity. So that C-corp, when a buyer comes in, they are going to buy the stock in that C-corp and therefore make it a QSBS qualifying transaction. So what is that new S-corp for? That new S-corp is where the C-corp is going to pay management fees. So the C-corp reduces double taxation. The C-corp pays management fees to do S-corp. The owner is still the sole owner of that S-corp, and the owner will get paid a W-2 wage to minimize their payroll taxes and Medicare, Medicaid, all that stuff. And then the rest will take in distributions. So from the owner's perspective, not that different from where they are right now, and not a terrible large amount of double taxation happening at the C-corp. So we this kind of solved the first and second problem that I listed above. So what's that LLC downstairs for? Through the F reorg, the F reorg is really a multi-step process. Your original S-corp becomes the LLC at the bottom. And we do that because we want to keep that S-corp's EIN. As I mentioned, to qualify for QSBS, it has to be original issuance. So you have to set up a new C-corp. And if you simply operate it out of that new C-corp, you would lose the old EIN. You would have to use the new C-corp's EIN. And so one of the other benefits of the F reorg is that the S-corp gets to preserve the same EIN at that new LLC level. And same EIN means you don't have to get new bank accounts. You don't have to move all your employees to the new entity. and you don't have to redo your contract. So you get to avoid a lot of operational disruption. So again, the F reorg is key to converting an S-corp into a QSBS qualifying C-corp. So now I'm going to touch a little bit on 1045 exchange. So we had a client where they were an S-corp. We were able to convert that into a QSBS eligible C-corp. But as you were learning more about the client and talking to him about why he wants to sell, what he's going to do after he sells, what is his plans and all of that stuff, we came to realize that his idea was, and he had already started a side business. And for him, retirement was to work on that side business. Well, we talked about what is that side business? And then we did some research and realized that side business can also be a QSBS qualifying company. So now we converted a second company to also be QSBS qualifying. And what that enabled was we sold the first company. It was sold as a stock purchase to a private equity firm. And then we rolled, because it hadn't been 5 years since they converted to a C Corp, we rolled the basis using a Section 1045 rollover. It's kind of like a 1031 exchange in real estate. So you roll the basis into the second company. And so as long as he holds the second company for the remainder of the QSBS period, he will qualify for QSBS. And, I find that a lot of business owners are serial entrepreneurs if they have the opportunity. And so, once they exit a business, they're not going to just kick back and relax. They'll start something else. And so the 1045 rollover also doesn't have to be for all of the proceeds. It could be for a portion of the proceeds, but it's another very important tool that allows to, at the very least, even if it's not QSBS qualifying, defer.
Subscribe to the channel, and for the full video and others, go to modernideasforbusiness.com.
That's available at time of exit. And lastly, a lot of people will again say that private equity doesn't.
Jay?
Yep.
Sorry for interrupting.